As this market continues to hum along, there is some undercurrents happening. So we're going to talk about the rotation in the market. My name is Brian Cannon, and welcome to Markets in 5. All right, I've got several charts I want to go through to discuss relative performance, but before we do that, let's just take a quick pulse check on the S&P 500. So you can see that we're in a very tight trading range right now. Traders are trying to determine if the market's going to break out to the upside, or if it's going to turn around and break this tight trend and turn around and break to the downside. So we've got some support here on the 200 if it does break down. And of course, we'll be watching other various levels of support to determine if it holds, if it does decide to break down. If it doesn't and it breaks up, green light. All right, this chart is the relative performance of the S&P 500 equal weight relative to the S&P 500 cap weight. So what does that mean? The equal weight essentially is all 500 stocks equally weighted. So it represents the market a little bit better. Versus the S&P 500 cap weighted is basically the top 10 stocks make up roughly 40% of the S&P 500. So when we compare the two, it's important to kind of note, because it can kind of tell us where we should be invested in the market. Obviously, when this relationship is heading down, that means that the top 10 stocks are outperforming the market, meaning that you would want to concentrate into the Mag 7 and to the stocks that are running. However, when this relationship flips and turns up, then it makes sense to reduce our exposure to the largest stocks and spread our risk across a multitude of other diversified stocks. So basically in the last year or so, really since 2025, I guess, the market this relationship has gone down, meaning we want to be concentrated in the top stocks. And so the S&P obviously has started to outperform, or has consistently outperformed the equal weight. However, we're starting to see this rotation flip. We're starting to see a breakout, meaning that we want to be a little bit more diversified within our U.S. stock holdings. All right, another chart I want to take a look at is value relative to growth. Okay, so again, this is value stocks compared to growth stocks. So you can see that the long-term trend is obviously way down, meaning that it's paid dividends over the last 10 years to be invested in growth stocks versus value stocks. Now this rotation does flip periodically, and so obviously when that relationship is heading up, then you would want to slant your portfolio toward value, and when that relationship is heading down, you want to slant your portfolio toward growth. And so we've had this downtrend of this relationship, and we have not had a breakout quite yet. So we're watching this relationship. If you have a clear breakout to the upside, then you definitely want to rotate into value relative to growth. We're not quite there yet, but you can see that over the last couple of months, it really is starting to pick up speed. So if that trend continues forward, then you definitely want to reduce the growth and pick up the value. All right, the next chart here is the NASDAQ relative to the S&P 500. So again, this is the relationship between the two. So when that relative performance is heading up, that means that the NASDAQ is outperforming the S&P 500, meaning that the NASDAQ is comprised of more technology in the S&P 500, although cap weighted is slanted 40% toward those top 10 stocks, which happen to be a lot of them are technology, but it is more diversified as an index. They've got more. They've got some value stocks in there and blue chip stocks. And so this relationship is still technically trending up, meaning that long-term technology is still outperforming kind of a broader array of stocks. However, you are over the last month or so starting to see this relationship pull down a little bit. So we're watching these levels. Obviously, if it breaks down further, then you would definitely want to scale back that technology and increase the diversification. All right, and this is probably, I think, the most interesting chart. This is the relationship of international stocks relative to the S&P 500. So obviously, you can see that over the last 10 years, it has paid dividends to be weighted heavily toward the U.S. stocks versus the international. And you're starting to see this rotation. So obviously, it started in 2025. But it was also pulling way out of the doldrums, if you will. And so 2025 had a nice run up, and then it kind of consolidated those gains. In 2026, it's continued that run up. It's had that breakout. That relative performance of international has has beat S&P hand over fist. So that tells you that traders are looking at the market and they're starting to rotate dollars out of the U.S. and into international. And this is a relationship. This is a formal break. So obviously, we're going to want to look international and make sure that we're taking advantage of that trend. Now, these trends can turn fast. So I would caution anybody that says, okay, this trend is broken, let's rotate all of our money to international. You can see as fast as it goes up, it can turn around and drop as well. But certainly it is a breakout. Certainly is something, if you don't have much international exposure, I think it's definitely prudent to pick some up and maybe to a little bit larger degree than normal. So in wrapping up, we'll continue to watch and monitor the various relative performance between the various indexes to determine where we need to be allocated. But if you have any questions, give me a shout and I'll see you on the next Markets in 5.